Hello everyone, welcome to the officer series of BFM. See, in officer series, as you know, we are covering all the subjects, all of them, ABM, BFM, ABFM, BRBL, everything, all the 4 compulsory ones we are covering. So follow the complete series, share it with your friends, like the video, subscribe to the channel. Okay, today I'll be covering important numericals and case studies on this chapter. Risk regulations in banking industry, one of the toughest chapters in your BFM. One of the toughest. I would call it the toughest. It's very tough. Okay, the numerical, the cases are really means this is the biggest chapter in your module B. Check it. You can check it physically. Okay. So I'll be covering various case studies as well as numericals over here. So follow the video completely, share it with your friends, like the video, subscribe to the channel, click on the bell icon. Okay, let's start. Let's see this case. The primary purpose of banking regulations in India, overseen by Reserve Bank of India, is to ensure financial stability. Means why does all these prudential norms of RBI, why do they exist? Prudential norms of RBI as well as other things. Why do they exist actually? Is to ensure financial stability, protect depositors' interest, promote fair practices, isn't it? Isn't it the point? That why do we have all these norms? Why do we have all these regulations? For that only. The framework is heavily influenced by international standards set by bodies like Basel Committee, BCBS. Ensuring Indian banking system is resilient to both domestic and global shocks. Now you see the shocks are so heavy nowadays, isn't it? Nowadays, shocks in banking or shocks in finance system are not like the earlier ones. Means earlier, when Harshad Mehta scam happened, at that time they called it a huge collapse and Nifty went, Sensex went 800 points down. 800 points down Sensex. Huge collapse. Today, in 1 hour Sensex goes 800 up and 800 down. Nothing happens. Okay. So, same thing has happened in banking also. The shocks have become severe, bigger ones. Okay. Now we are all witnessing this. So, ensuring global shocks. The prime example of framework in action occurred during a period of rising NPAs and subsequent global financial volatility. So, rising NPAs. See, 2008 was a subprime crisis, right? That was one of the major problems in the banking system. Because of this, the volatility was huge. The volatility, what do you mean by this word volatility? Volatility means fluctuations. Okay. The other word to volatility is standard deviation. That is another word. Volatility means standard deviation. Both these are square root of variance. Okay. So the prime example for this framework occurred during the period of rising NPAs. In 2016-17 also we had this same problem. Specifically our country, Bharat, okay, and subsequent global financial volatility. The RBI mandated that all scheduled commercial banks adhere to the stricter capital adequacy norms, often exceeding the global minimum set by the Basel Accord. So now also you see RBI's norms are more stricter than Basel norms. Basel says 8% CRAR, RBI says 9% minimum without CCB. So 1% extra RBI has kept. Okay, and to all the nationalized banks, it has kept it around 12%, highest, isn't it? So, this is the overall case. Now, let's look at the questions. By requiring higher capital to risk-weighted asset ratios, the RBI ensures. So, why does RBI require higher CRAR? What is the reason? CRAR means what? CRAR means capital to risk weighted asset ratio, capital upon RWA. Capital includes two types of capitals, tier 1 and tier 2. RW includes three types of RWS: credit, market and ops, right? So, why does RBI require higher CRAR? Banks have sufficient buffers to absorb unexpected losses without failing. Remember this, which one? 2008, Lehman Brothers. Immediately, one night over, Lehman Brothers, one of the big banks. Few of my friends were working in Lehman. Single night, everything gone. Why go 2008, 2022? Credit Suisse, the same bank or the same company which said, we don't accept Adani bonds because they are not worthy, they are very cheap, we don't accept them. January 2022, Credit Suisse said so. August 2022, Credit Suisse gone, purchased by UBS. That also was a compulsory purchase, otherwise there would have been another Lehman Brothers collapse. Okay, so the point is, I am not discussing that point about Adani and Lehman, this Credit Suisse. The point is over here is, you must have sufficient buffers, which we have kept. Indian banking system is one of the best banking systems. Why? I will tell you. We don't do leverage banking. Foreign banks do leverage banking. Okay, that's called as fractional leverage. If I am having 100 rupees of my own, they will distribute 1000 rupees. Not even 1000, they will distribute 10,000 rupees based on rupee 100 only. By buying the options, by buying the futures, by doing the swaps, various derivative instruments. In our case, and they don't have secured loans that much. See, foreign banks don't have that much secured loans. Indian banks mostly focus on secured loans. That is one of the best options. Okay? So, banks have sufficient buffers to absorb the unexpected losses without failing. This proactive approach prevents individual bank stress from evolving into a systemic crisis, right? Some problems, see, like the same Lehman Brothers crisis, I'll tell you. Plus, there were other banks also in our country also. 2017, there was major crisis. But nothing happened that much. Why? Because our banks are safe. Okay? So, Lehman Brothers has taught everything. 2008 subprime crisis has taught every bank this case. Okay? Systemic crisis. One bank fails, the whole banking system fails. Why? Because the bank which fails has issued a debentures. See, I'll give you the same example. Lehman Brothers, it had issued the debentures. Those debentures were purchased by all other banks. So, this gone, the debentures are gone, they face the loss, and it's a systemic crisis. After subprime crisis, you see there was a company called as AIG, Tata AIG, you remember? Out of that AIG, American Insurance Group. Okay? So, systemic crisis, it relates to a ripple effect, that's called as ripple effect. Ensuring financial stability of the banking system. So, that is obvious. So, the answer is what? All of the above, isn't it? Second, how does a stable banking system inherently safeguard public funds? So, how does a stable banking system, if a bank is stable, how does it ensure the safety of public money? RBI's ability to license, audit, even direct the merger of or liquidation of troubled banks provides a strong safety net. So, RBI has a right now. It can direct any bank which is in trouble. It can direct other banks that kindly purchase this. I'll give you an example. 2017, Yes Bank faced a major crisis on the Diwan housing. DHFL failed. At that time, Yes Bank had a crisis. But what did RBI say? RBI directed SBI, LIC to purchase that. They purchased the Yes Bank shares. And it was saved, and now even, of course, both of them earned a lot because Yes Bank shares at that time were around 7-8 rupees, right? And now they have gone up. So, See here, after all, these things happen in the banking system. Okay. So the case over here is this, that RBI's ability to license, audit and even direct the banks to merger or liquidation, okay, that has given us a strong power. Protecting depositors' interest by active role of ECGC. Protecting depositors' interest by active role of ECGC. Right, isn't it? ECGC, Export Credit Guarantee Corporation. So, both A and B and none of the above. Type in the comment section, what do you think? Is it both A and B? Is it both A and B? Think everyone. Both A and B. How many of you say both A and B? How many of you say both A and B? The answer is not both A and B, because this answer is wrong. DICGC, right? If you want to protect investors' money, you are focusing on DICGC. ECGC is for export, so only this answer is correct. Only A is correct. If you want B to be correct, you have to write it over here DICGC, not ECGC. Okay? Got it? Numericals. Leverage ratio. Tier 1 capital is given as 75,000 crore. On balance sheet assets are given as 118 lakh crore. Off balance sheet exposure after CCF, okay, is given as 2 lakh crores. Derivative exposure is given as 50,000 crores. Calculate total exposure and a leverage ratio. Very, very, very important numerical. Very important. Try to solve this, everyone. How many of you can solve this? Try it. $75,000 crore tier 1, on balance sheet 118 lakh crore, off balance sheet 2 lakh crore, derivatives 50,000, of course crore, total exposure and leverage. What is leverage ratio? Leverage is a short-term ratio, kindly note. Leverage is a short-term ratio for 30 days. If your bank faces a run on the bank means everyone comes running to your bank for withdrawal of deposit. Then do you have that much, those many HQL, high quality liquid assets, to support that withdrawal for 30 days? That's why I said it's a short-term ratio. Second one is NSFR. So here we are talking of LCR, liquidity coverage ratio, Basel III, okay. So leverage, okay. Oh, yeah. So leverage ratio, okay. Okay. I was talking of LCR. That 30 days ratio is a LCR ratio. LCR. Leverage is different. Exposure upon capital. There are 4 ratios in Basel. Okay, all of you kindly note this. There are 4 ratios in Basel. Which are the 4 ratios? The 4 ratios over here are, one is LCR, liquidity coverage ratio. Second is NSFR, net stable funding ratio. Third is leverage, this one. Okay, and fourth one is your Cook's ratio. Okay, CRAR ratio. These are the 4 important ratios. So here we want leverage. So funding upon your total assets upon your capital. So let's find this out. See what is given. Total exposure is what? 18 lakh plus what is this? 50,000 derivatives exposure, right? Plus 2 lakh. This is your total assets. Assets means what? Assets means exposure. Loans. So this much are your loans, right? Then what is leverage ratio? Leverage ratio formula is very simple. Leverage ratio means your exposure. Some books write it capital upon exposure. Some books write it exposure upon capital. Anything. Whatever standard, whatever method you follow, it is same. But 2 components must come. Okay. So it is capital upon exposure. In some books you will find it exposure upon capital. One and the same. If you find it capital upon exposure, it will be in terms of percentage. Okay. So here we are finding it capital upon exposure. So capital divided by exposure. What is my capital? 75,000. What is my exposure? Total 20,50,000. All these three added into 100, of course. So it is 3.66%. What does this mean? What can you say about this? My capital is 3.66% of my loans. My capital is 3.66% of my loans. Okay. So what does RBI say? RBI says 3% for this. Okay. So this is my total exposure. This is my leverage ratio. Got the answer, everyone? Clear? Next. Total exposure of a bank is given as 15 lakh crore. Minimum leverage ratio is given as 3%. Leverage ratio, minimum is given as 3%. So you are required to find out the tier 1 capital. So what is the tier 1 capital? See, firstly understand, this leverage ratio is 3%. Exposure is 15 lakh crore. So leverage equals to what? Capital upon exposure. See, I'll show you over here. Leverage equals to capital upon exposure. Okay, just now we saw this. Into 100. You have to multiply it by 100 because we are dealing in percentage. So now what is given to you? Leverage is given to you. 3 equals to, what do you have? Capital you require? Capital upon, what is my exposure? 15 lakh. Okay, so I'll just write it 15 LCR. Okay, into 100. So just cross multiply it. So capital equals to 3 into 15. Okay, upon 100. Right. So do it, everyone. So capital equals to, let's try this. Capital equals to, what is it? 15 lakh crore here into 3, right, upon 100. Try this, everyone. What are you getting? 15 lakh crore. Huh? It's a big figure. See, let's remove this crore for some time because everything will be in crores. Okay, everything will be in crores. So let's remove a crore for some time. Everyone try this. 15 lakh into 3 upon 100. So 15 lakh. Okay, try it, everyone. 15, 1, 2, 2, 3. Okay, upon 100 into 3, right? 15 3 is a 45, 45,000, and that also crores. Never forget this crores. So this much is the capital required. 45,000 CR. See, leverage ratio problems are always easy. Leverage ratio problems are always easy. Kindly note. Very simple. Same formula. Okay. So now, everyone got this? Before going, everyone, kindly note the new batches of Adda 24/7 have just started. Okay, they are still in the starting phase. So everyone, kindly join the new batches immediately. The new one more batch is starting now, pro batch. Don't miss this pro batch. Okay, I'll show you. See this. Download Adda 24/7 app from either Google or iPhone, wherever you are. Download it. Okay, by just downloading, you'll be getting 1% extra discount. 1% extra directly. So 1% extra you'll be getting. Click on CAIIB. Say this. The new batch. Okay. Officers Pro batch. Check this. English one. Okay. All the 4 subjects are covered. Compulsory ones. ABM, BFM, ABFM, BRBL. Everything is covered. Okay. Plus numericals. The case studies like this. Now see this. Here I have covered only 2-3 cases. In paid classes, we will be covering the huge detailed concepts are clarified. See, concept is very important in BFM. Concept clarity is very important in total CAIIB, not only BFM, total CAIIB. You can't just learn the things. How many numericals will you learn? How many case studies will you learn? If your concepts are clear, then you can do anything, isn't it? So that's why the concept clarity is the main focus in the batches. You get e-books, mock test. E-books are and mock test. They are chapter wise also. Per chapter you are having mock test. Per subject, per chapter. Plus you are having full length mock test also. 10 plus. 10 full length mock test. Like same as that of your exams. So join this ASAP. Use the code Y432. Y432. Okay? Click on enter. Look at this. Y432. See this. 82% discount you are getting plus 1% extra. 83% by downloading the app. So don't miss this. 83% discount you will be getting. Plus I would suggest you to join the Increment Mahapack of CAIIB. Don't miss this. Increment Mahapack is one of the best Mahapacks. Okay, it is right now it is triple validity. See this. Right now triple validity is going on. You buy for 5 months, you get it for 15 months. You buy for 9 months, you get it for 27 months. Plus you get 15 plus batches per subject. Plus you get physical question bank, physical formula bank, question bank, formula bank, study planner, plus 82% discount, plus 1% extra through the app. So everything is plus, 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 plus. Don't miss that. But the code, remember the code, Y432. Never forget this code. Okay? This code will give you all the benefits. This code is very important for you. Y432. Never forget this code. Okay? See this 82% plus 1% plus triple validity plus 15 plus batches. Win-win. Okay?